All right, guys, what's up? And welcome back. I'm Johnny, and this is Chelsea, and we're local agents and real estate investors here in Orange County, California. And today we're going to make the whole 50-year mortgage thing super easy to understand.
Yeah, this topic sounds complicated, but it's actually not. Here's a simple version. A normal mortgage is usually 30 years long. That means when your loan is set up by the bank, it is paid off over 30 years worth of payments, one every month, or a total of 360 payments.
And there's also other term options. For example, you can have like a 15-year mortgage, which pays the loan off in about 15 years instead of 30. Now, right out of the gate, that sounds better, but the shorter the term of the loan, the higher the required payment every month. And the opposite is also true. A 50-year mortgage just stretches the timeline out, so instead of paying the loan off in 15 years, it takes 50 years to pay it off. So it's a lot longer to pay it off, but also a lower payment every month.
This is great because it essentially makes houses more affordable by making the payment lower. Now, the big pushback is usually around having to spend the next 50 years paying off the house, and I totally get it. But it's important to remember that you're not trapped for 50 years. You can pay extra anytime you want, and that extra payment goes straight to the principal, lowering the amount of interest you pay and shortening the term.
And almost nobody actually sits on a loan for multiple decades. Most people will refinance when the rates drop or they move or sell.
The other concern for a lot of homeowners is the amount of interest they are paying, which totally makes sense.
Here's the thing though, a lot of homeowners utilize interest-only loans. Now that means when you make a payment on all these types of loans, all of the payment goes to interest. So technically they never get paid off, which sounds kind of funny, but what these loans do is they create more affordability for home buyers, and the homeowner is usually counting on market appreciation to build equity and then leveraging the portion that would be going to principal for business or investing. So my point is that paying higher interest on a mortgage isn't really a new idea. It's actually a tool leveraged by a lot of wealthy homeowners.
So how does this impact housing in Orange County? Very simple. Homes here are expensive, and the monthly payment is the biggest barrier for most people. If that payment is lower, more people qualify to buy.
Here's a quick look at real numbers in a completely hypothetical scenario. This is a 30-year mortgage compared to a 50-year mortgage, both with 5% interest rates. Take note of a couple things. The difference in the monthly payments is roughly $1,345 per month less with the 50-year mortgage. The trade-off is that the difference in the interest is considerably higher over the life of the loan, assuming that you never refinance into a shorter term or lower rate, which really isn't likely.
All right, now we really want to know what you think. Would a longer mortgage make buying in Orange County easier, or do you think it's a bad idea? Drop your thoughts and questions in the comments. We read them and respond. Plus, they help us figure out what videos to make next.
And if you want more OC market breakdowns, real estate explainers, and some behind the scenes for some of our flips, hit the subscribe button and come hang with us.
Thanks for watching. God bless, and we'll see you next time.